Reddit investors from Wall Street Bets are shaking up the market and sticking it to the man by buying up stock in GameStop and AMC, and this is forcing big hedge funds to lose billions of dollars. And now you want to know what's going on, that way you don't end up on the losing end of this equation. What's up everybody, I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. Here we are, early 2021, and we're talking about GameStop and AMC booming, at least in the stock market. I can't believe I'm making this video. I've been kind of ignoring this topic, thinking it would blow over, but you really can't ignore it anymore. And so I'm not gonna have a long-winded introduction. Let's just get right into what's going on. Reddit is a forum where a bunch of people can go and just talk about things. One of the sub-forums on Reddit is Wall Street Bets, where people can go and talk about things related to the stock market and Wall Street. So people have been going on Wall Street Bets talking about what stocks that they think would be a great investment. Personally, I've never been able to get into Reddit, but on Wall Street Bets, people have been kind of posting stocks that they think are good investments. They've been sharing their portfolio, and recently people have been targeting stocks that are heavily shorted. Normally, when you invest in a stock or any investment, you make money when the stock goes up. So if you buy shares of a stock at $100 a share and it goes up to $200 a share and you sell it, then you made $100. When you short a stock, you're betting that the stock is going to go down. So what happens now is if you short the stock at $100 a share and it goes up to $200 a share, you lost $100 a share. So when you short a stock, you want its price to go down. The way it works, I'm not going to go too deep into this, but the way it works is when you short the stock, you're not buying the stock, you're actually borrowing it and selling it. So when you short the stock at $100 a share, you're actually selling the stock at $100 a share by borrowing it first, and then you hope that the stock is going to go down in price, let's say to $50 a share, and when this happens, you end up buying the stock. So you borrow and sell it first, and then you buy it whenever you come down to end the transaction. So if the stock goes down, you make money. But if the stock goes up and then you buy, now you lose money because you sold it at 100, and if this price goes up to $200 a share, now you have to buy it at $200 a share, and you sold it at 100, so you lost $100 a share. The thing that makes shorting stocks so risky is there's no limit to how much money you can lose. Because if I invest $1,000 buying 10 shares of the stock, the most money I can lose is $1,000, because if the stock price goes to zero, then I just lost all my $1,000. The stock is not going to go to a negative price. But if I short the stock, there's no limit to how much money I can lose, because if I short the stock, I sell it at $100 a share, and it could go up to $200 a share, or $300 a share, or $400 a share. So there's no limit to how much money I can lose. And this is where things get really tricky, because now if you are shorting a stock on a brokerage and you enter into the short position at $100 a share, and now the stock goes up to $200 a share or $300 a share, you are deep in the red. You are losing a lot of money, and the brokerage can force you to now get rid of your short position, meaning they can force you to buy the stock at a huge loss, and then you have to make up that lost money. So some people on Wall Street Bets found the GameStop stock, and they found that its shares were 140% shorted. That means that more people were betting against the stock than there were even shares of the stock out there. This was something completely unheard of. And so people on Wall Street Bets thought this could be an opportunity to create a short squeeze. Now, before we get any further, you need to understand that stock market manipulation is illegal. Stock market manipulation is when you have a coordinated effort of people that are working in conjunction with one another to pump and dump a stock. And so this would be, you get executives of a hedge fund together, and they get into a room and they think, you know what, let's buy this stock and we're going to run the stock up in price, and as soon as it hits a certain price target, we're going to dump all of our stocks and we're going to walk away with all the money, and everybody else is going to be a loser. What's going on here is a little bit different. It's just a bunch of people on a forum talking about which stocks they want to buy. I mean, it'd kind of be like me coming onto YouTube and saying that the best stock out there is Tesla, and I'm putting a bunch of my money in Tesla. That's not what I'm doing. But you essentially have these micro analysts, people who are on this forum talking about why they want to buy GameStop, and people are listening to this analyst position. The reason why people have been buying up GameStop is for a few reasons. One, people have been seeing the amount of shorting that's been going on with GameStop, and people think that if they can move the price of GameStop up, then the people that are shorting the stock will be forced to buy the stock, and this will force the price of the GameStop stock even higher. GameStop stock. Second, there is some, keyword some, value argument here, because some people say that GameStop has been seeing more digital sales and this could create more potential in the future. Now, this isn't a super great argument because GameStop is still a brick and mortar store. They've still been losing money year after year after year, but some people have been claiming this. And third, this is kind of a way for retail investors, regular people, amateur investors, to kind of stick it to the big dogs on Wall Street, the hedge funds, because of all the kind of resentment we've seen with hedge funds getting bailed out in 2020, hedge funds getting bailed out in 2008, but the regular people not getting anything. And so this is kind of a way for people to get their money back through the market. So people on the forum were making the argument as to why they were investing in and putting their money in GameStop. You saw this new trend of people calling a YOLO portfolio, the you only live once portfolio, where people were putting all their money, $10,000 or $100,000 or even $500,000 all into the GameStop stock because they believed that GameStop would go up in the future. Then this kind of excitement got more people excited about investing in GameStop, especially because the stock was so beaten and down, so more people started to buy it, and so the price started to kind of trickle upwards. Once the price started to trickle upwards, that's when more people started buying, and that's when the short sellers, you had all these people that were shorting the GameStop stock, these people were starting to get stuck because they were betting on the stock going down. And you had these major hedge funds betting on GameStop going down, but now the GameStop price is going up because you had all these people on Reddit and Wall Street bets buying up the stock, and now the stock is going up and hedge funds are losing money, and some of these hedge funds started closing their positions, so they were forced to buy the stock at a higher price than what they sold it for. And so now you have more buyers coming in, and this pushed the GameStop stock even higher. In the beginning of 2021, the GameStop stock was selling for below $18 a share. But at the time of me recording this video, January 27th, the GameStop stock was around $320 a share. We're talking about a 1,700% price growth in just a few weeks. The retail traders, the amateur traders that came in and bought up the stock were making a killing. I mean, some people were making millions of dollars, and the people that lost everything were the big hedge funds and the people that were shorting the stock. Like this company, Melvin Capital Management, had a big short position in GameStop, and by January 25th, they had lost 50% of their value. Not just 50% of the value of their short position in GameStop, but 50% of their entire company's value. They had lost 50% of their assets under management, and so other companies came in, other investment firms came in, and they started buying up shares of Melvin Capital Management. That way they don't go under. And so now you have these other hedge funds coming in, buying up other hedge funds for pennies on the dollar because they are losing everything on this GameStop short. And then if that wasn't enough, Elon Musk came out and he tweeted GameStonks, and that single tweet helped the GameStop stock go up by another 100% or so on January 27th. Now, Elon Musk has gotten his own fair share of trouble tweeting about the Tesla stock, and that has cost him millions of dollars. I think he was fined like $20 million when he did that. So he is not scared to say what he feels, but this is the environment that we're in. People that were on Wall Street bets, people that were reading these Reddit forums came in, they bought up the stock, they're making millions while the big dogs are losing everything. We just saw the exact same thing happen with AMC. AMC had a huge short position. People on Wall Street bets and Reddit started talking about AMC, and then people started buying up the AMC stock. It went up hundreds of percent in just one day, and now all the people shorting the stock were forced to cover their short, and they were forced to buy the stock at a huge loss. And so you had these major money management firms losing millions and millions and millions, if not billions of dollars. And you have the retail traders making a ton of money off of it. The higher these stock prices go, the more these short sellers lose money, and the more short sellers that are forced to cover their short by buying the stock, and this puts even more buyers into the market, causing the price of these stocks to go up even more. It's gotten so bad that now you have brokerage accounts like TD Ameritrade restricting trading of GameStop to certain users, because the last thing that they want is for this bubble to burst, and now people losing a ton of money, and now they're coming after not just GameStop, but now they're coming after the brokerage account like TD Ameritrade, saying, what happened to all of my money? So that's what's going on. Now let's get into what you need to understand and how you can actually protect your wallet. What I love is I love the fact that we have a ton of young people and new investors and traders coming into the market and getting excited about the stock market. I love that. I also love that people are making money. We have a ton of young people making hundreds of thousands of dollars just by trading stocks. That's amazing. And it's also pretty cool that people have been able to stick it to Wall Street because they feel like they've been left out while Wall Street has been getting these billions of dollars worth of bailouts. Here's where the issue is. When people don't know what they're doing, or they're investing money based off of hope and speculation, and then you start to see this euphoria because everybody thinks that the market and this game can only go up and you can only make money, and then you start leveraging up your bets with margin and debt, and you start refinancing your home to go all in. That way you can make a whole bunch of money and get rich very quickly. That's where you see issues happen. The one thing in common with every single financial bubble that has ever burst in history is euphoria. When people start buying an asset, not because they believe in the value of the asset itself, but just because they want to get rich quick, that's how you start creating a bubble, because people are buying it just with the hopes of getting rich, and so people start buying at unreasonable prices. And then when you leverage that up with easy debt, like margin at low interest rates, now you can create the bubble a whole lot bigger because people are buying not because they care about the asset, not because they care about the stock, not because they care about the underlying value, but all they care about is getting rich quick because they think that their system, their game, their investment cannot go down because all they see is it going up. Even in the social media influencer YouTube game, we have this whole new influx of people who have made their first $100,000 and they're showing off how to invest in stocks, how to trade in stocks, just showing these risky trades, hoping that you can get rich quick. It is not sustainable to make 1,000% returns every single year. Okay, and so if people are making $100,000, great. But if $100,000 is all you ever made, and now you're showing people how to do the same risky thing as you, now you're creating more kind of derivatives of how to invest in these risky assets, and now you have more and more people buying into this risky investing game, and eventually, as people start to get that taste of success, they start to leverage up their bets because now you think, wow, I'm an expert investor. I made $10,000, I made $100,000, and now you start leveraging up your bets because you think, what if I can turn this $100,000 into $500,000? So now you start to leverage it up, you start making more risky bets, and eventually, once the money starts to fade away, that's when the whole system starts to crumble. If you made a lot of money, great. If you saw a 1,000% return, even better. I am happy for you. I'm glad you were able to make that money. But now, as you're starting to make this money, I want you to be logical here for a second and understand what you have done. This is not sustainable. It is not sustainable to make a 1,000% return on every single stock. It is not sustainable to see 100% returns in a day in a stock. There's a lot of money floating around out there. I mean, we have all the stimulus money being printed. We have trillions of dollars being ejected into our economy, and we have the lowest interest rates in the history of time. So there's a lot of money out there. And you might think, oh, my margin account is letting me borrow money at only 2.5%. So if I can invest my money, and I can get a 5% or a 10% or a 200% return on my money, because nowadays 200% sounds like nothing. If you can just pay 2.5% and borrow a ton of money, then you can leverage up the amount of money you're making 5-fold, 10-fold, 20-fold. But this is where I need you to step back and really understand what's going on and be smart with your money. That way you can come out of this with money in your pockets and not one of the people that made a ton of money and then lost everything. We have seen that happen time and time again. We saw it happen with Bitcoin in 2017. We saw it happen in the stock market in early 2020. We saw it happen in real estate and the stock market in 2008. We saw it happen in the stock market in the 2001 dot-com boom. So what you need to understand is, okay, if you made a ton of money, great. What are you going to do with this money now? Are you going to leverage it up more and hope it happens again? Or are you going to take a step back and understand how to really protect this money? That way you can grow it sustainably. Nothing can go straight up forever. I need you to remember that. Because once you start winning, we start to get this hot hand fallacy. It's where we think, oh, I made a ton of money here. And I took this money and I leveraged it up and I made even more money here. And now you take this more money and you leverage that up even more. And then you make even more money here. And now you think that because you've done it a few times, you think that you can never lose because you just won, and won. And now you keep doing that thinking that you cannot lose because you got this hot hand. You keep making money every time you roll the dice. But eventually, things will slow down because 1,000% returns in a month are not sustainable. This is gonna sound kind of crazy because of the environment and the market that we're in, but the stock market is not supposed to be a casino. It's not supposed to be a place where people trade on emotion. It's supposed to be a place where people go to invest in companies based off of the value the value that a company provides. Right now, we're not seeing that with companies like GameStop and AMC. People are buying up these companies based on emotion, hoping to get rich quick, which is fine. If you made a ton of money, that's great. There's nothing wrong with that. I'm happy you made a lot of money. But what you need to understand is that eventually, over the long term, things will correct. And you just want to make sure that you're protecting yourself when that does happen, and that you're not the one that is leveraged up to your eyeballs when things start to go down. And now not only did you lose your money, but now you owe your brokerage money because you borrowed more money than you even had. Like every morning at 9:30, we have a team meeting with our minority mindset team. And for the last few days, as soon as 9:30 hits, I start my team meeting. And then I get this whole list of text messages from a bunch of my friends who have never invested in stocks before, talking about how much money they have made in GameStop and Tesla and AMC and all these stocks. And they just keep talking about how these stocks keep going up. And now they're telling me how they're going into debt to margin up these trades. When you have never made money in the stock market before, when you've never invested your money in the stock market before, when you have no idea what investing entails, what fundamental analysis, what a value investment is, what a technical investment is, and you're just buying up stocks because people in a random forum are telling you to buy, that's when euphoria hits, and that's where you got to take a step back and really understand what's going on and protect your position, because nothing can go up forever. It can last a few days or a few weeks or a few months or maybe even a few years. But eventually things will correct, and you just want to make sure you're protecting your money, because if you made a ton of money, you made a ton of money. Protect it. If you enjoyed this video, here's a video that I think you'll love, and while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. So if we draw this out, when you invest your money, you're using your money to be a producer, not just a consumer. Remember, when you're a consumer, you're just eating the product or using the product. When you're the producer, you're the one that's making